Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital, and today's episode is all about how VC success is truly measured, because it's really hard to tell sometimes, and it's more than just financial math, although that is a big part of it that we'll talk about. And on today we have Henri Pierre-Jacques, and he is also a successful fund manager on, is it Fund 2 now at this point?
Fund 2, yeah.
Fund 2, and in early stage venture. And so before we start, why don't you give a quick introduction and a little bit of background?
Yeah, Henri Pierre-Jacques, based in Miami, started Harlem Capital technically 9 years ago as an angel syndicate, 7 years ago as a fund. My partners, three of them, they're based in New York. I've known them since 2010. We met during college, became friends. And really, we started Harlem Capital because we just saw a lack of diverse founders. You know, this is years before George Floyd happened. And so that was kind of our thesis. Like, we wanted to back diverse founders. Nobody was doing it. We went to business school to recruit. And then we realized, like, hey, nobody's doing what we want to do. Like, let's just start our own fund and do it ourselves. So, yeah, here we are, 6 years later, post-business school. We've raised $174 million of capital, invested in 70 plus founders. And, yeah, having fun. So, enjoying the journey.
Awesome. Very cool. So I guess like to kick it off, maybe we start with the financial metrics. I mean, for those that don't know, like we have sort of like all ranges of knowledge from founders and to investors, and I don't know if everybody knows, so I'll just quickly say like there's ways to measure a fund that LPs use, and there's certain terminology and they mean different things. So like there's TVPI, which is your total value to paid in capital. And there's DPI, which is like the gold standard, of course, that everybody wants. That's like your distributed to paid in capital, and that's what actually matters. Like that's your cash return. It can't go down, it can only go up from there. Whereas the TVPI can change all the time because it's based on unrealized. Yeah, and I'm sure we'll have some stories about that. And then there's IRR, but that's also like sort of time based and can also be gamed. So those are the main, I would say, like financial ways that a fund gets measured technically, but there's a lot more to it than that. So I guess, Henri, what are your thoughts on this? Like, how do you think about your funds and the way that they get measured in terms of their success?
Yeah, it's funny because you said successful fund. And I'm like, are we successful? Right? Like, you kind of see it like, you're like a series. Fund 2 is like you're a Series A company, right? Like Fund 1, you have, unless you have a track record, which we didn't, we had our angel syndicate, but like not like years and years of a track record. Fund 1's kind of like your seed bet, you're betting on the team. Fund 2, there's some product market fit, but not really. And then Fund 3, it's probably one of the harder funds to raise because it's more like a Series B, and there's actually data to look at, which is all the metrics that you mentioned. And so, yeah, I mean, I think those are like obviously like the metrics you measure. One of my LPs, who's a very successful investor, said at the end of the day, your success is determined by one cell in an Excel file, right? Like, what's the capital that you return to your LPs? Like, that's the cell that determines if you're going to be around for decades, many decades as a fund. And only 16%, according to Sapphire Ventures, of funds get to Fund 4, right? So 1 in 6 funds get to Fund 4. I think for Fund 3, it's like somewhere in the 30s, maybe low 40s. So like 1 in 3 funds get to Fund 3. So it's a really high bar, like one, because of the metrics required, and two, because a lot of people don't want to do it, right? Like if you're on Fund 4,
realize what's involved
you're
in it.
investing for 20 plus years. Like it's a hard job, and that people realize, hey, this isn't for me. So I mean, I think like in the interim, like those are the obvious ones, like the best LPs, similar to the best founder or similar to the best VCs, have to find like the non-obvious metrics, right? Like everybody already knows Sequoia is really good. The question becomes like, how do you get into Sequoia? If you can't get into Sequoia, then like what's the next Sequoia, right? Similar for founders, like everybody knows that like Cursor is the best AI startup right now. Everybody wants to invest. Like, how do you find the next Cursor, right? And so I think LPs have to think about it the same way as VCs. Like, yeah, like you want to get into the best companies if you can get allocation, and if you can get it, it's probably not as much as you want. Then the question just becomes like, where does the rest of the allocation go, and how do you find the other companies or other funds that don't have like the very clear metrics? And that's in the day for everything. It's people, right? Like you're assessing the people. We had our annual meeting last week, and one of our speakers mentioned like you're looking for, how do you predict somebody's inflection curve before it happens, right? And that's ultimately what we're trying to do as venture capitalists. And the LPs that are investing in emerging managers, that's what they're trying to do. The LPs that want blue chip funds like Andreessen aren't trying to do that. But like you're trying to find people's inflection points before those inflection points happen and things become more expensive and you get smaller allocations. And typically that's assessing the managers, the people, what's your market position, what's your win ratio, what's your graduation ratio, so how many of your companies are going from seed to Series A, like all the other things that like maybe not be baked into TVPI or all the other, DPI metrics that you mentioned.
Yeah, that's exactly right. And you know this, I think we met through it because one of our vehicles at K Street is a fund of funds for the District of Columbia. So we look at a lot of managers all the time, and I think like, we're not really focused on those like new emerging managers necessarily, depending on a few factors, but it's like the way that you look at as an LP when you look at a fund one, it's like you really care about access the most, right? Like, could you get access into really good deals? And then in fund two, it's like, can you keep doing that even though you have a bigger fund size? And you don't necessarily need DPI yet on fund one because you won't have it probably. But you want to make sure that there's like firm building happening, like processes are in place. It's becoming
Yeah.
like a different thing than it is when it's a fund one, just operationally. And then fund three, it's like you can't hide, right? To your point, like you kind of need DPI on fund one. Like you've had enough time now to start showing the winners, and there's not really
Depends
any.
on the vintage.
True. It takes time for these things to mature. And like the other thing is, I've been investing for 8 years now, I think, almost 9, which is still early. Like you still need like a lot of my early investments, that you're not going to really know for sure if I'm a good investor for like 10 years, right? I mean, a lot of them have already started exiting now, so
Yeah.
that's thankfully, but that's not necessarily the case. And there's other ones in our portfolio that, are like Series D stage and we think they're going to exit quite big, but maybe they don't, and that really impacts things. But you don't know until you have that,
I mean,
like
that's the hard part is like the feedback loop is so long until the question becomes like, what do you do in the interim of the feedback loop?
yeah,
And
like how are you learning?
how are you adjusting like your voting processes, your portfolio management, like all the other stuff? Like, how do you adjust that before you really know? Because, yeah, I mean, we have LPs who are GPs of other funds, and they're like, you haven't been in the game long until you've had a unicorn go to zero. Like, a lot of the best fund managers, like, it's happened, particularly if you invested before
Yep,
2021.
yep,
Right? So, that happens. And so you think you have a winner and you didn't. And I kind of go back to, Josh Kalpman in the first round always loves to reference Annie Duke. And it's like, you can't say the output was good because or the input was good because the output was good. And you can't say the input was bad because the output was bad, right? You can make a good decision that ends up being a bad output because of for whatever reason, geopolitical risks, a war happens, like COVID happens, there's a multitude of things. And you can make a bad investment and then it ends up being good for multiple reasons. And so that's the hardest thing to assess. And that's something that we reflected on because now we're going into our second decade of investing. So we're kind of calling this era like Harlem Capital 2.0. And it's like, okay, we started the firm at a terrible vintage time to start a fund, right? Great vintage to raise because money was there, bad vintage to get returned, right? And if you look
yep,
at like the top 95th percentile to the 50th percentile, it's like the tightest band that we probably had in 20 years. It's like point 0.2, it's like 1.1 for 50th percentile and like 1.35 for like 95th percentile. It's like irrelevant, like, a
yep,
quarter of a turn, which usually that is like a 2 to 2.5x delta between the 95th and then 50th percentile. Um,
right.
and so it's like, okay, well, whether you're top quartile 1.35 or mid at 1.1, you suck and
Yeah.
on a relative basis compared to the markets. And so the question becomes like, how did I do? Is it because of me? Is it because of this? Is it because of the vintage? And then like, do you change everything? No. So like the hardest part is like, what do you change? And I think that's really tough, right now for a lot of managers. Like when you're reflecting on the TVPI numbers and benchmarking yourself against S&P, and especially if you're fundraising and LPs are telling you all these things, and it's like what do we change to get better? And like was this us or was this the vintage? And that I think it's really hard, and it takes a lot of self-reflection for managers to like actually assess like what to parse out between eggs. I think it's really easy right now to be like, oh, either none of it was us, it was 2021, and it's really easy to be like, hey, like we're really bad, like change it up, fire the team. That in between is kind of where I think the best managers will end up in like taking some responsibility, but also acknowledging like, hey, like part of it like just wasn't us.
Totally. Yeah, exactly. I mean, you said something earlier that like really rings home to me too, which is that it's like you have a successful fund, you're a successful fund manager, but then you're like, am I? I don't know, like I don't know. But like when you think about like what metrics do you track that you actually track inside your portfolio to keep yourself honest, to like really think if it's a good, if things are going well.
I mean, graduation rate's number one, for sure. Like, are your companies getting marked up? In the beginning, we were less focused on that. We were more focused on revenue traction. I think what we realized is that like now that we've been in the game longer, like yes, the business matters, but like hype matters a lot in venture, and a
Yeah,
business is never worth, its metrics, right? So like I think
yeah,
the reality is like, when we go through our audits, like your business will never get valued at what it is on an audit level basis unless it's been marked up by another VC firm. And so I think that does matter. So momentum matters a lot. So graduation rate for sure. Velocity is important. So like revenue traction, revenue growth, customer growth, whatever the metric is for the company, like that's definitely important as well. I mean, we track win ratio a lot. Like we're really want to keep ourselves honest. And like frothy markets like now and in 2021, you see that come down as it should. There's more competition. There's more exuberance, much higher terms than companies are worth. So like you should be losing slightly more deals. And so we track win ratio by firm, by partner, and that's like something that we track as well. So those are probably the top three, I would say: graduation rate, revenue traction, and then win ratio.
yeah. Those are pretty similar for us. But the other two that we have been looking at recently, anyway, is well, we've always looked at like their cash efficiency, like how much
Especially
they're
like
burning.
2021 to 2024, like yeah,
Yeah,
like matters a little bit less now because a lot of our companies are fine. But yeah, like there was 3 years where we were tracking that very tightly.
exactly. Yeah. I mean, we still track it because we want to know like what's the runway? Are they achieving the right amount of inflection to get to that next fundraise that they are
Yeah,
planning to have or going to need to have? Or like how healthy is the company from like a balance? How healthy is our portfolio from like a balance sheet perspective? Because some of those companies will reinvest in, but we can't reinvest in all of them. And so then, that can lead to challenges. And then the other thing is just like the competitive landscape, I think in like the multiples landscape for certain types of businesses, because it changes, drastically. Like, I mean, like to your point, like 2021, you might have had like 10 or 20x ARR, where today it's not that, right? Like it's a much lower multiple unless there's some
I was
other
like
reason.
2021 was more than 10 to 20.
Could be a lot
And
more in
and
some
now
cases,
and
right?
now is also more than 10 to 20 for AI companies.
Right, for
It's
AI.
like
Yeah,
30 to
exactly.
50.
But if you have like companies in your portfolio that were from that era that are B2B SaaS
Yeah,
and
it's tough. I mean, yeah, I mean, it's a hard market, right? We see it as a customer. We use products that we don't use anymore, right? We're like, oh, like we're paying 8,000 for this, 12,000 for this, and it's like, let's have this AI agent like build it out for us, right? At like 20% of the cost, and it's a custom built tool versus like we're just using the generic tool. That's a software tool. So I think like AI is very exciting. It's scary for your existing portfolio, which is probably mostly software, and you're like,
yep.
oh, like you need to like cut your price, change this, be AI enabled because even us as a customer, we're like cutting software products like quarterly that we just like don't need anymore. So we know our portfolio is going to go through it. Yeah. So from a multiple perspective, I mean, like what we're seeing right now for valuation is like if you're a repeat founder or an operator, 20 to 40 million posts, pre-product, pre-launch, pre-bank account,
Yeah.
like just guaranteed. We've literally waited like on two deals like to like for the bank account to be fixed so we can actually send the money. If you're a good founder, you're raising 4 on 20 pre-product, and I'm like, I started the year thinking 25 would be a great vintage. If you ask me now, I don't think it'll be as bad as 21 because we're seeing revenue growth that we've never seen, but I don't think it's going to be as good as people thought it was going to be.
Yeah. I think that's
So my
probably
guess
true.
is it probably ends up being like I don't know, maybe 2019, 2018. But I think the prices are just way too high. But like you're still paying for better quality founders and better revenue, but like it's still too expensive. But ultimately, like, some investors can afford to stay off the field. Most can't. You kind of have to
Yeah.
always be in market. One for founders, two for LPs, three for VCs. So I think it's really hard for people like to stay out, even if they think it's like, a hype cycle.
Yeah, I think this is really true. And I think like your point is right on the pre-seed stuff. Like when we see stuff like that, like they do, it does exist, but they're only raising like 200 to 500K, right? So like for
Yeah,
most funds, that doesn't make
can't
any
do it.
sense. You can't do it.
And it's probably
So
not a
like,
great founder because a really good founder doesn't need to raise 500K. Like they're just going to raise millions because they can.
well, not necessarily. I don't know. That's a good point. Maybe, but we've seen a few that are like second-time founders, really strong. They're doing this on purpose. They don't want to raise a bunch of VC money early because they know they're going to raise it
So
later.
they're doing
They'd
like
rather
family and
just,
friends round or like actual like
yeah, like
venture
angels
fund.
and
I mean,
like,
that's fine because it's like it's your friends and
former
support. But I think
investors that were in your first company that you liked, like stuff
yeah.
like
But if
that.
you're doing like $1 million, like a sub $1 million round, and you're a repeat founder who raised at least a Series A, I mean, I just haven't seen it. Like I think it's just like I mean, I've seen founders get to 3 million of ARR in 6 months with 3 employees. They're profitable, and I'm like, hey, like, why are you even raising venture? You own 100% of the business. You're doing 1 million of ARR per employee. It doesn't really make sense. They're just like, oh, because we can. Like, I can raise 3 on 30, take 10% dilution, give myself more runway, have a VC partner, right?
Right.
And so like, I think it's a balance. I just haven't found like really, really like that many successful repeat founders to like do a small venture round because it's like I can take such little dilution for such like we had a repeat founder who raised a $10 million seed round, right? Pre-product, pre-launch, and previously sold his company for 9 figures. Like when it's that easy, like there's just such low risk for the founder to do that. And yeah, like
Yeah.
maybe it's like, hey, look what happened in 2021, and it was frothy. But like in the day, a lot of those founders are fine. Like they took massive secondaries. Like I think most of them were like, hey, I'm glad I did it because the business went to trash. Like so like though
Good.
people say it, I still haven't found many founders who actually do it. Like people talk about it, but then like we just did a round 3 weeks ago, and it was supposed to be like 3 on 18. Previous founder got the 5 million of AR, raised like 25 million of capital, and the round ended up being six in the 20s. And it's just
Mhm.
like, it's like I could take the same dilution, double the capital, and very similar. That business didn't work because of 2021. It was a fintech business. But it's just
Yep.
like, so I find founders to say that, but then like when it comes to the round, it's like, oh, like we want to push you up and let's like
Yep.
add another tier one into the fund to co-invest. And now you have two great investors. Maybe 10% like say, oh no, I'm not going to do I'm not going to do that. I'm going to do the smart thing and raise less.
Yeah. 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 I think it's becoming more common though. That's my hypothesis. Like we've seen more
More
of it
more
recently.
founders want to like be profitable and like non-venture for longer,
Yeah.
for sure. Like
Yeah.
more
Like they
than I've
just
seen.
control their own destiny a little bit more at the earlier days so that like they
Yeah.
can get to a point where when they raise later, it's not like, so
I mean, that's what they
difficult.
should do, and that's why I've told founders like, hey, like, I'm like raise like, even like 4 on 20 seems like like hey like that's like low, right? Like I'm like raise 4 on 20 posts, so like if things don't go well, like you could still like do a seed or seed plus, right? Because you skipped the pre-seed. So I'm like going for like getting to the Series A on 4 million, like it's possible, especially with AI, but it's still not easy. And it's like if you have any hiccups, like there's so few funds that could do a 20 to 30 million dollar seed plus round. Like you're talking like 10% of funds, maybe
Right.
less, right?
Right.
Versus like, hey, if you do a 15 post or 18 posts, like yeah, maybe you have 30% of funds who could do a $20 million seed plus. And so like I tell founders that, but it's like I mean so few of them listen.
I know. I
They're like,
know.
oh, like I'm believing my like I'm top 1%. As it is, like as a
Right.
founder, you're only doing this because you believe you're top 1%. Otherwise, you shouldn't be doing this.
Yep. Yep.
So you're
Yep.
like, I'm not doing this to raise a C plus, right? Like, and if that happens, then we didn't do what we were supposed to do anyway.
Yeah. It is a really interesting time to be investing and just like watching how the whole thing is playing out.
It's like you're
Um,
trying to tell like people who believe they're 1% to be like to have an average mindset, right? And end
yeah.
of the day, like the founder is going to have the distribution curve, and obviously we all know about the law of outliers, and it's like 80 to 90% of you are going to return less than 1x of what you raise. So like most of
Yep.
you are actually below average.
Yep.
Right? Like average would be like 1x. Like just give me back what I gave you.
Right.
Like
Right.
um
Exactly.
right? But like you can't tell a 1% or a 50% like quote. It doesn't work. So like I also empathize with it because it's like somebody, I remember when we went to raise our fund, and I was talking to some, high net worths and some alums and like, hey, like, oh, you should go, like, you're really smart, you're graduating from Harvard Business School, like you should go work for this company for 3 years. And it's like, I believe I'm a founder, I believe I'm top 1%. You're telling me to go do average things. So like
Yeah.
I empathize with it because it's like telling a GP that who wants to go, and it's like, oh, go work longer. You're in your 20s. It's like, no, I'm going to do this now. I'm going to raise more money than you. Like,
Yeah, yeah. I mean, yeah, it's the smart thing versus the hot thing, I think. You know?
but like,
And
it can
people,
end up, like if it works, it's both,
yeah, that's true.
right?
That is
Like
true.
if it works, it's both. And if if you got out in 21 and you were Coinbase or Lyft or Uber, like you were both. And if you missed the window, like, Headspace or Calm or a number of other companies, like, you don't feel good.
Yeah. Yeah,
But a lot of
exactly.
people made a lot of money in 21 too.
It's true. It's definitely true. And what do you think about like other metrics that, I mean, maybe like other non-financial metrics that define VC success? Like, I'll give you an example. I mean, like to me, I really believe that if I get invited to around like the one I'm talking about, where they're only like there's no real pre-seed, it's just like a tiny group of select handpicked people that were like investors of theirs before or whatever. Like that's really meaningful to me to be able to be included in some of those things. But it's like I really think that access to the right deals
I mean, it's the
is
most
the whole
important thing for sure.
yeah. It's the
I mean,
most
yeah, like
important
the
thing. Like,
best deals matters. Like we track every quarter, like this, we had a partner meeting this morning. We track on Crunchbase like every diverse seed round across the entire country, and then we like compare it to our CRM system and see like what is our like look ratio, and then we exclude the deals aren't relevant for us, right? We don't do healthcare, we don't do biotech, we don't do consumer. So like exclude those, and then like what's our like C ratio, which traditionally has been like it depends on the group. For women, 50%, for Black people, 80%, 80 to 85%, and then like people in between, right? So like we track that quarterly, and then like we review like okay, cool, like what were the deals we missed? What cities were they in? Who led that deal? Should we have seen it? Do we want to reach out to the founders still because they may do a seed plus round before the Series A, which has happened twice for us, right? So like, that's definitely important. I mean, the other ones that matter. I mean, co-investors matter some. I don't care because we lead. So
yeah.
like, there's very few people who we actually co-invest with. Like, it happens occasionally. It actually just happened recently where we co-invested with First Round and Lower Hippo on two separate deals. Like, first time for both funds, just because both of us typically want more ownership. But for really good founders, funds take less ownership than they would usually. So that's what happened
Yeah.
there.
Yeah.
But usually,
You're,
usually we can't co-invest with them.
but you're right. I mean, like we probably co-invest half the time, so it does matter to us. Like, are our co-investors inviting us back to do things? Or we like because we know which investors we would not invite back to be in a deal with.
Yeah,
You know what I
yeah,
mean?
yeah.
So it's kind of like a soft metric, but it matters. Or even just like your reputation with founders, like what a founder would say about
Yeah, I
you.
mean,
Like,
we do that. We have NPS score. We do a founder survey every year. We ask like, why did you choose Harlem Capital? What's our superpower? Where can we improve? We like shared these slides last week in our annual meeting, right? Like, so like we definitely track that stuff because I mean, yeah, to your point, like that matters the most. So I know if I'm doing well, where it's like I'm trying to win deals, and I can send them references, and my founders like will take that call within 24 to 48 hours because they know like it has to be done within 2 days to win the deal, and like that's not a part of their business, it's not a priority, but like it's kind of full circle. And then it's like also like for me, it's like the deals you lose. Like I mean, it was really cool. We had our founder summit last week. We had great speakers like Big Sean and Colin Kaepernick. And so for the first time, we invited non-founders to our founder summit. So like, hey, we have these great speakers. We should like let's give it to people who we want to like have in our ecosystem. And one of them was a deal I lost. I don't know, like 6 weeks ago,
hmm.
uh, to a tier one fund in New York, and it was one of my HBS classmates, and I was like kind of sad, but did the process, and like she came, right, came to it, and was like, hey, like this was incredible, like you should be really proud, like it's cool, like be a part of the experience, like would love to come back, and I think like that for me matters as well, is like maintaining the relationship, and it's like the deals you lose, like you still have that founder strength, and like another like they send you a founder reference, which has happened. We've had multiple founders that we've invested in where like we got the reference from a founder that we passed on who sent us that deal.
Oh,
They're like,
that's
hey,
awesome.
like either
I
we
love that.
passed on you or we lost, and it's like, hey, I love the process, and I want to introduce you to another founder, even like if you pass or I chose another fund. It's like stuff like that. We don't like have like a metric for that, a scorecard, but that qualitative stuff to me, like I think speaks like, okay, we're doing a good process. Either we passed or we lost. Like they still enjoyed it. They thought we were value additive. They want to come to our events. They want to send other people who are smart to us. Like that to me means like you're staying in the flow of the winners, which is like
Yeah.
why it's like we want to invite like winners to our events. It's like, hey, we didn't invest you, but like we just want you to be on our ecosystem. Like we want winners
Yeah,
around
exactly.
us.
Yeah, yeah, I think that's really important. Yeah, I mean, we also track like where do our deals come from? Like most of them come from founders, right? Like our former founders that we've invested in, or other founders that we didn't invest in, but they just, maybe we passed, but like we were helpful anyway, and we had ran
Yeah.
a good process and we're transparent the whole
Ours is from
time.
all over.
Yeah,
VCs, LPs, interns, outbound, events. Like we have a pretty dispersed funnel. We definitely the inbounds less. The accelerators are less. We used to have a really high accelerator, but like
Hmm.
Techstars has gone through their own stuff. YC has gotten too big, so we've gone less than accelerator. So like we track it and we look at like the funnel conversion. So we have like 5 stages in our funnel from like meet them to call to memo to full team to invest. And so like for every single source, like we look at like what's the conversion, and then like when the conversions are falling, like that's like where we spend more time in other conversions, right? And so in
yeah,
different markets, it's gonna ebb and flow, right? Like in this kind of market or in 2021 where it's super competitive, like venture is gonna drop, right? Because it's competitive and founders are taking 15 to 20% dilution max. And so you can't have two big funds in the round versus like 22, 23 where things were slow. Nobody's getting follow-on rounds. Like VCs were sending
yeah,
us deals. Everybody's like, hey, do you want to do my company C plus? Right? Like
yep.
that's just not happening as much in 25. So like the sourcing mechanisms, they do change in different markets, and like we track that and then we adjust the team's like energy based on what we see from like a conversion cycle perspective. Kind of like what you would do for a sales team, right? Like, hey, our SEO strategy or outbound's down, like we need to put more resources like to this area.
And how do you track, or do you track like impact type metrics?
We just do it in our survey. So like usually we ask like diversity for the team, diversity for the board, number of employees, cap table, um, advisors. We get like advisors, advisor roles. Like those are probably like the top five for us. So we kind of know like how much capital has been raised for our companies, how many employees they have, what's their board makeup. I think it's like 35% of boards have people of color, half the boards have women, your employee base, etc. Like all that stuff for us is like what we track. It's not, we don't do it every year. We probably do it every like 2 or 3 years just because, it's not going to change that much.
Yeah.
Um, but yeah, like we don't like report that to our LPs. Like we do that more internally because we're not like
No,
all
but
that
yeah, I
exposed.
would think it's something that like we also track differently from you, but we track as well, and that to us is a measure of success. Like we want to make sure that we're doing certain things that
Yeah.
hold ourselves accountable for at the end of the year, even if it's not like part of our fund mandate per se.
Yeah,
Um,
makes sense. Yeah,
but
it's
I
like
want to
a
switch
it's a
gears.
byproduct for us.
Yeah, and it is important, I think. So it tells you a lot about your process along the way too, and it just informs the way you want to be doing your deals moving forward or sourcing them or whatever. But I want to switch gears and ask you a couple of different questions now.
Let's do it.
So, what is the most surprising thing you've learned that's sort of like inside baseball about venture capital that you didn't know before, like wouldn't most people don't know on the outside about the industry?
Uh, that most people know about. I mean, the immediate thing that came to my head was it's really freaking hard. I think you kind of know that going in, but I don't think people like fully process how hard the law of outliers is. Like, I mean, it's like really hard, and like as it's harder to be an outlier fund, in my opinion, than to be a unicorn founder. And so I think I underappreciated that. I think, time gives you that like humility.
Yeah.
There's like all the other nuances of like the other immediate one that came to mind for me, from like a management perspective, like how much you can actually like put off on LPs versus management fees. Like your
Yeah.
like annual meeting and your board meetings and this and that. You're like, oh, actually, like my management fee pile is bigger than I thought. And when I
Yeah.
first started, I was like shocked, and I was like, wow, this is crazy.
Yeah.
And it makes a big difference, right, in terms of like managing the fund. I think now as a GP, it's like that's a big part of my job. Like deals are one part, but like the rest is like bonuses and healthcare and team
Right.
and
I mean, it's a
team
business, right? You
retreats
have
and all that
a
stuff in
team,
the
it's
business. And so
employees.
yeah, I think
Exactly.
that part like you can't be trained for it. And I was surprised like about how much can be expense to the LPs. And I think if that wasn't the case, I think it'd actually be, even more of a rich person's game because even with that, like it's still hard, especially for
Still
smaller
hard.
funds.
Yeah.
But then you also appreciate like, hey, like every dollar that you do expense to the LP, you're not investing, so your gross versus net spread is getting wider, right? Like so there's all
Yep.
these like balances that you have to
Sure.
like balance out, that you have to think through.
Yeah. And what would you say is your biggest failure and what did you learn from it?
In life or as a venture fund?
Can be either. Can be either. Uh, Yeah.
Uh, I mean, it's funny because like, I don't like view like things in that framework as like failures because I feel like it's like a negative connotation. Like my brain's like very much, I'm like a super positive person. So I kind of like push things like what's next, like how do we fix it and solve it. Uh, I mean, like for companies, like, I think like whenever a company like fails or dies, like I definitely take it to heart. Like so it wouldn't just be one, but it's like I view like founders, it's like N of one, right? And for us, it's like a portfolio between 30 and 45 companies depending on the fund. And I backed this person. I thought they were really smart, and like that's just really tough. Right? I feel like to some extent, particularly if we led the seed round, I'm on the board. Like I
Right.
know founders feel this ownership, but like I also feel it too, right? It's like, hey, like did I waste like LP capital? Did I waste my team's time? Did I push through this vote if the team was like pushing back and I barely got the votes and did a
Yeah.
conviction bet? You can't harp on it as much, but I think like those like definitely like I think about it, we reflect, we do postmortems. But I think ultimately like the part of the reason I am a venture capitalist and why venture VC firms work is because like we don't view things as failure, right?
Right.
Like it's like, hey, like AI came up and now it's like, forget about all that crap in 21 and like people can like venture capitalists can really clearly like put those things behind them. And it's like, cool, we're gonna focus on the hot new shiny things, open AI, Cursor, etc. I think like that's required in the job
Oh
because
yeah.
90% of your job is like you are, is a failure. Um, and it kind of reminds me of a GP I spoke to. They don't let juniors sit in their partner meetings. We do, but I
Hmm.
understand why. He's like, hey, like 99% of decisions that I make, 99% of decisions that a junior tells me will be right because they're going to be wrong, right? So if a junior is
Yeah.
like, hey, like this founder sucks or we shouldn't invest in it, it's like that
Then they
senior
come
associate will be
back and
right
tell you.
99% of the time. And he's like,
Yeah.
I'm getting paid to be right 1% of the time, right? And
Yeah.
so like I think that mindset of failure is hard because it's like you're only supposed to be like the opposite of failure is are you a winner? You're only a winner in venture 1 to 3% of the time,
Yeah.
right? So
Yeah.
like, I think like that's why like, I like view things like very differently because it's like that's not even I can't view my life through that lens because you would just be living a life of failure, and that's
Yeah.
partially why I like venture to some extent.
I think like, and you're right, like you have to be an eternal optimist to be in venture. There's no other way. Like you just have to, right? Because
And if you
things
weren't, I
fall
don't think
apart.
you could be in the industry. 'Cause I think
No.
you would die by 1,000 cuts.
Oh yeah. Yeah. You wouldn't, yeah, definitely. So
Like
I
the
think that
lows are like really low, and there's a lot of them.
and there's a lot of them.
There's
And
a
that's
lot of
most
them.
of the time,
Yeah,
right?
there's fundraising, there's portfolio, there's you can't raise around, like there's
Yep.
your
Most of your
employees
companies are
leave,
going to die.
like
Yeah. Like,
there's a lot of them.
yeah, it's a lot of them. So you have to be an optimist, but like when you do have failure, and I guess like being an optimist maybe allows you to take all these hits, right? Like to take all these hits and
And like
turn them
and to
into
not
something
like
positive.
reflect on them because it's like I don't know. Also
Exactly.
like
Like, learn from them.
to me like everything is relative, right? So it's like okay, I didn't get into Stanford Business School, I got into Harvard, or I didn't get the bank I wanted, so I ended up at this bank, or like I didn't get the group I wanted at the bank that I didn't want, right? But
Yeah.
like I'm still like an investment banker at Bank of America, which is the top three. Like and so it's like to me it's also as I reflect like on my life, and it's like my mom grew up in Detroit, and my dad grew up in Haiti, and they ended up going to Harvard Medical School and meeting each other. It's like I don't know. I just feel like I talk to them like about my failures, and yes, like regardless if you're rich or successful, like you do have to acknowledge like we each have failures and we each have hardships. Like rich people have hardships too. But I guess for me, it's just been harder, and maybe it's like you need to reflect on it, but like it's been harder for me to like acknowledge that because it's just like, oh, okay, it was a failure, but like relative,
Yeah.
like not really. And to like 95% of the people in the world, and maybe that's a curse, like they would not care.
Right.
But like
Yeah.
that is like the reality. And it's like when I hear stories about my grandparents or my dad, like, or my uncle lives in a hut in Haiti, it's just like, okay, cool, it was a failure. We lost this deal, or I
Right.
lost $4 million of, somebody's money, yada, yada. Like, so I think it's been hard for me to reflect on that. And I hated that question in interviews, like when I was like in banking and private equity. I just like because like I was like, okay, Adam, I got a B in physics.
Yeah.
like,
Yeah, I know. But I wonder too if like maybe you're not, and don't take this the wrong way, but maybe you're not taking big enough risks. Because I feel like when I used to feel that way, and then I took way bigger risks and had way bigger failures, and then I really felt them. Like I had to
but I
reflect
also
on
like I don't even like view like I don't view I don't view risk the same either. Cause like I remember everybody's like, oh, like how'd you start Harlem Capital? Like how'd you take the risk of like starting your fund at 26? I was like at the moment, like at the time, like I literally didn't view it as a risk. It was just like my downside is I leave HBS and I get a six-figure job if it just doesn't work out. Like I'm
Right.
gonna be fine, right? And so it's like my brain like literally didn't even like compensate like what the risk was of like, hey, like you want to go start your fund after being an associate, like you've only been working for 4 years, like do you want to like
Yeah.
go raise $40 million and manage other people's money, like right? And all my other friends like you're crazy, like we're gonna go make $600,000 work this PE fund. Like, so like
Yeah.
I also think like my brain just doesn't like comprehend like those level of risk things. I remember people would always ask me that in like a lot of podcasts after we raised our first fund was like, how did you take the risk to like raise this fund? I was like, honestly, like I never thought about it.
Well, you're the only person, and like, I guess we're on, this is probably episode, I want to say 16 out of 20 for this season. And these questions are only in this season, but you're the only one that's answered it that way. So,
The risk
I kind of
perspective.
like it. Yeah, yeah, yeah. Just the failure question and like yeah. So, but it's good. Like you learn from everything you do, and whether you call it a failure or however you perceive it or whatever it is, like you do what you have
I
to
just
do to
like I think
make
it's like you just have to like I like I'm such an action oriented person, so it's like when something bad's happening, like I'm like a super fighter. It's like there's like no anxiety, no like take like it's like I'm like gonna go in and like I'm gonna spend hours and hours like to fix a problem immediately or do whatever I have to do next.
yeah.
And like it's great for business. It's it can be bad for marriage. So
Yeah,
we've definitely had arguments about this exact topic
yeah.
because like that's just like I'm a action oriented person and I don't take time to like harp on stuff like oh like it's so sad or like oh this employee life okay cool like what's next like what's your action plan
Yep.
what's the like how much is vested how much is unvested
I'm sure your wife
right like
loves
yeah like not great for like marriage but great for business.
totally. Yeah. Yeah, yeah. I think that's a good point. Yeah, my husband has similar qualities, so I can. Okay, last question. What would you say is the best advice you've ever received? And this can also be in venture or in life. Doesn't matter.
I mean, the quote I use a lot is "Everything in life is a people's business," which was my private equity boss, and I just like focus on people, whether it's for investing in founders, building relationships with friends, network LPs. Like I just think the more I remember, we had the head of LinkedIn B2B sales do a talk to our founders, and he was like, "You have to remember, like, it doesn't matter if you're selling to an enterprise, a public company, a startup. Like, you're still selling to people." And people think like the sales cycle is different for consumers versus enterprise. And like, yes, it is, but like the person purchasing is a person.
It's still a person. Yeah.
And even last week at our founders summit, we had a salesperson come in who used to be a comedian, and he's like spoken to like hundreds of top companies and sales reps, and he basically like was a top sales rep because he was a comedian. So he was like my edge was like I knew how to connect to people, make them laugh, and like be personable. And I remember a line he used. He's like, the earlier in the sales call that you talk about your product, the cheaper your product is,
Yeah.
right? Like the longer in the sales call where it's like we're just having a discussion, we're talking about life, and he did a couple examples where he had our founders go up and he asked them a problem and he did a conversation. Like the longer it takes to get to where your product is, like the more expensive your product is.
Yeah.
And like it just like I think like the more you focus on the people, like the better off you're going to be served. And that's what I was really good at. Like regardless of what I was in investment banking or private equity, which are very like like you're in your cubicles. Like I always like took the time to like walk around the floor, spend time. I would, I was the social chair of my group, like hosting things, inviting people to the gym. And it's like sometimes I was perceived as like, hey, you're not working. Like I was not, you're not the hardest worker. But like ultimately, I think like I became the most like one of the more successful ones because then I had the people aspect. Then it's like your bosses are investing in you because like, hey, maybe you weren't the smartest, but it's like I knew you more as a person. Like I knew who their kids were, like all those things. And so
Yeah.
I focus
Yeah.
on that. Like I think it's just like I think a lot of people remove that. I think particularly in an era of AI, like knowledge is just it's just every
Yeah.
even
Yes.
before AI, I would tell people like hard work is table stakes. Like as much as people like oh hard work and we're a startup and we work 6 and 12. It's like cool like that's like differentiated from average, right?
Yeah.
Like when you work in banking and you work in private equity, my worst week was a
Part of
120
it.
hour week. It's just the
Yeah.
culture, right? Like that's like so average in banking is 100 hours a week,
Right.
right? And so I think it's like when we're talking about like our circles, it's like hard work is table stakes. Like it doesn't do
Yeah.
anything for you. And I think now with AI, like knowledge is table stakes, and even more so now, like access to people, it's going to matter even more than it ever did. The other slogan outside of everything like people's business is my dad's slogan is work hard, play harder. And so like
Yeah.
that's been my Instagram and Facebook handle, for a long time. Like I like what's the point of life, right? Like I think, working hard, yet it's table stakes. And I think if all you do is work, like life is meaningless.
Yeah. I
It's like
totally
that
agree.
like PE culture, like of like, hey, like wow, going from banking and like you can't talk to your, you don't have an office door of your MD. It's like private equity, smaller firm, 13 people going to their houses, knowing their wives, meeting their kids. Now I'm a mentor to my old boss's son who's working in finance. Like that's like what I wanted to bring to Harlem Capital. I think that leads to like longer employee longevity. Like our average employees been at the firm for 3.5 years. Like our ex-employees,
That's
like we
great.
still talk to, we're close with. Like that's the stuff to me like that matters long term because it's like yeah, you ring the Nasdaq bell for 1 hour or 2 hours, 10 to 15 years from now, but like what happened like the 10 to 15 years before the 2 hours of the Nasdaq bell? Like cool, you're
Yeah.
rich now, you're at the mountaintop, but like, as you found, like the mountaintop is lonely, and then like the journey matters more, and it's isolating, and it's like if you're not enjoying that until you get to there,
Yeah.
what are you doing it for?
It's the point of life. It's
Which
the
is
what
like
makes
not
life
the,
worth
like the SF mentality. Like the SF mentality is like, gotta become a unicorn,
it.
work hard. So as an investor, I appreciate it from my founders. And as a human, I'm like, hey guys, this is like, yes, it's an advantage for me for you to have this mentality. But like as a human, as a friend, as a peer, like make sure you're taking the time and space for yourself. And I think that's something that a lot of my founders appreciate and most of their, investors aren't telling them to do. Because it's like
Right.
for us, like, yeah, it's like make me returns, crush yourself, become the unicorn faster. So it's a balance. Like maybe it's not to my advantage, but that's just who I am.
No, I think it is. I mean, if you're gonna really like inspire, like really, really, you have to take care of yourself to be able to take care of a business and make it grow. You have to be like 100% there, and the only way you can be 100% there is if like you really are living and you feel like you're really living and you're not dead inside, you know?
Yep.
So I don't know. I subscribe to that theory as well. But anyway, that's a wrap.